Okay, Sam,
Sounds
over to
good.
you.
Okay, thank you, Pat, and thank you, team. It's really a great pleasure to be here. And as I shared earlier, this is a regular education outreach that Endowus does, and it's really excited because it's Singapore Press Club. Obviously, the MC and the investment committee in particular have engaged Endowus, and we are providing our services to Singapore Press Club, to help become good stewards of your resources and help grow the wealth of Singapore Press Club as well. But today is really focused on the individual members and your own personal finances, and trying to provide some input and guidance about how to approach your wealth systematically and also holistically. Two things that we feel are very important in approaching wealth. And it's unfortunate that our education system fails us in teaching us and preparing us well. And the institutional kind of financial companies also fail us because they don't provide us with good advice or access to cost. So today's session is a special session for the individuals and members of Singapore Press Club. And as a result, we've offered a special voucher. It's a big voucher. We don't offer it to most people. So it's a very, very special voucher for you guys. It's 50% off fees.
Wow,
And
that's
actually
terrific.
we put zero caps on it for you guys. So it's unlimited cap. And it's available until next June. So it's a special favor for our special relationship with the Singapore Press Club and the members. So you can, we're all used to QR coding these days. So whip your phones out and scan the QR code, or we'll send this over to Janet, who can share the recording and the QR code so that other members can use this benefit as well. But we really do encourage you not to share with too many people, that it stays within the Singapore Press Club, because otherwise we may, run into trouble. And so if you can just, it's a special, favor for Singapore Press Club members only. So if you can just limit the use, that'd be great.
Sam, I can imagine that giving us this kind of extras is gonna hurt your revenue quite a bit.
Well, we hope that there's a growth that will come that will eventually be beneficial for both our clients and us as a business. And so we're looking long term, and that's what we need to do to build our wealth. And it's also the right thing to do when we're building a business. So we're completely aligned. As you know, we're all about aligning the best interest of the individual investor, us, Endowus, our partners who are our fund managers and broker partners. And if our clients do well, then we do well. So it's only good for us to do so. And Singapore Press Club is a special relationship. So
thank you.
I'm going to provide a special favor. So there you go. Okay.
Yep.
So we'll move on. Just a quick intro about Endowus. And the company was created 3 years ago to really solve the pain points that we felt ourselves as individuals. So I am one of the co-founders, founding partners, and chief investment officer. I also have this title of chairman, but really, I'm just one of the many partners that have built this company together. And all of us have extensive experience in the industry, so we're experts in our field. I was at Morgan Stanley for 17 of those years, 26, and in the asset management business, where I ran tens of billions of dollars investing in public markets and doing macro and asset allocation as the chief investment officer. And then I became the CEO for a while before I retired and moved to this new world of fintech, financial technology. And even when I was at Morgan Stanley, I struggled trying to invest my own money, even though I had access to, Morgan Stanley's private wealth business and, private banking services. Because, as an individual, the costs are really, really high of accessing great products. And sometimes we don't, I knew there was a lot of products out there that are great, but they wouldn't give me access to it. And the advice that I was getting was not that great. And many times, especially as individual investors, we get pushed products by either our banks or our, financial advisors. And often these are inappropriate products that lead to, poor outcomes. So our mission is simple. It's just to help people just invest better, to live easier today and live better tomorrow. And one of the biggest generational challenges that we face as a society is the issue of retirement adequacy, and trying to reach, retirement with enough money for us to last our lifetime. And so, to do retirement well in Singapore, we couldn't do it without CPF, which is such a core part of it. And so after 2 years of working with the CPF board and the Ministry of Manpower, which is the policy governing ministry, and the regulator MAS, we became the first and only digital advisor for CPF. So we're the only digital platform that allows you to manage your CPF, SRS, and cash holistically and conveniently through expert advice. We have a wonderful team of 36, really deep experience in financial and technology across the board. We do a lot of education and literacy programs. We have an insights page where we publish really interesting and insightful articles about how to manage your investments, how to invest, and how to manage your CPF and your SRS and prepare for your retirement. So you can sign up for that for free. We've held sessions at SGX, and education sessions, and I think this is our webinar that Eugene joined before, and the top left was the one that I think he joined, which is Biden versus Trump, the US election and the impact on financial markets. But we also had top right, Lou Cheng Chuan, who's a great friend of mine, who began the 1M65 movement, which is 1 million by 65. But he's figured out that CPF millionaires, multimillionaires is possible by investing your OA through Endowus. And now you can get to 4 million or 5 million. And that's as a couple, if you maximize your investments well. And so, as an ex-Singtel employee, he's not, paid by the CPF or by Endowus, but he's figured out independently that you can use the Endowus platform to grow your wealth in CPF and across different sources of income. So we have great content that basically helps people invest. And obviously we're at the Singapore Press Club. So, we work with the press in a lot of our PR efforts. And this is not the final list, but we have CNA and other guys as well. So sorry that we could only put these in, but we work with the press, and we regular participants in radio and newspaper and publishing. We also have just begun a Business Times a column. It's called The Science of Wealth. It's a monthly column that we publish with the Business Times. So we want to contribute to discussions and help educate people and improve financial literacy in Singapore. And just a quick explanation of what is fundamentally wrong with the investing experience in Singapore. And I talked about incentives and how we want to align incentives so that we are doing what's in the best interest of our clients. It's called Fiduciary Duty. It's something that is front and center and the most important ethos when it comes to financial service providing. And it's all about incentives, aligning incentives so that the service providers and the vendors and the product providers are all working towards the best interest of the client. Once we do that, the rest will all fall into place. And this is a funny cartoon. It's a doctor prescribing a medicine to a patient saying, try this medicine, I just bought 100 shares. Or a doctor saying, oh, I would like to prescribe this antibiotic because every time I prescribe it, I get $500. It would be ludicrous to think about this. And similar if you go into a Singtel shop and you want to buy the latest Apple iPhone 12, and they tell you, no, you can't get the Apple iPhone because your only option is Huawei. And the reason I'm going to push Huawei to you is because I get $1,000 kickback for every phone I sell. Taking away the choice from us to select the best product because they are getting a commission or a kickback would be ludicrous in the in the medical field, or even in like buying a simple phone. But it's so prevalent in financial services because this chart shows you the reality. Who is making money off of us and our future wealth? It's the distributors. So the distribution are the banks, the private banks, it's the financial advisors, including insurance agents who peddle really terrible products called insurance-linked products, and also brokers and also fund platforms, which tout themselves as free of fees, but in fact they all make money, and the most amount of money not from the clients but from getting these hidden kickback commissions, which are called trailer fees or retrocession fees. So the individual investors pay sometimes the distributors, but they also on an ongoing basis pay the fund management company. So let's say you bought a BlackRock fund or a Schroders fund or an Aberdeen fund, and they charge you, the broker and the banks charge you an upfront sales charge of 2%, or a platform fee of 0.3% in the case of Fund Supermart. But they also charge you on an ongoing basis 1 to 2% of fund management fees. But the fund manager who actually does the job of managing your money doesn't keep that. They actually give more than half of it back to the banks and the distributors in the form of these trailer fees and retrocession fees. So the distributor say that we deserve it because we own the client. And so we are giving new fund managers access to our clients, and therefore you should pay us. And the individual investor are the ones who suffer because they're paying ludicrous amounts of fees to the distributors, but also to the fund manager, of which more than half goes back to the distributor as well. So it's a broken system. In the developed markets, this is illegal. Most people don't know how much they are actually paying. Insurance-linked product I mentioned are the worst of both worlds because Singapore pays one of the highest amounts of insurance premiums in the world per capita, and yet Singapore is undercovered in terms of insurance coverage because what you're doing is buying insurance-linked investment products, and you're undercovered on the insurance side, and you have poor returns on the investment side. So it's actually, people tout it as the best of both worlds, but it's actually the worst of both worlds. What you should actually do is invest separately and buy your life and insurance products separately, so you're focused on the coverage on the insurance side, which is the tail risks removed, and then on the investment side, core investments across equities and fixed income to grow your wealth over time. And Singapore is below average in terms of their fees. In fact, it's a very developed market, but the cost of investing here is really high. So they're below average in terms of the fee, and the developed markets compared to the developed markets of US and Europe and Australia, it is a significant gap. And one of the reasons is because in these developed markets, commissions on financial products is illegal. So, the whole thing I told you about the doctors and the medical field, also the whole thing about, the Singtel kind of, story, which is ludicrous. That doesn't happen in financial services in developed markets because it's illegal to receive commissions for selling financial products because it leads to disincentives, and it leads to misalignment of interest. So moving from here, we've just basically cleaned it up for you. So we're completely aligning the incentives correctly. So individual investors pay Endowus for advice. What we do is access the best-in-class funds. So the wrong funds are not pushed to you. So like banks and other guys will push you a China fund this year because it's hot. Next year it's a US fund or the emerging markets next. But we tell you, no, you should be globally diversified and low cost in investing. And we access institutional share classes, which are low cost. So a popular fund in Singapore is the PIMCO Income Fund, sells tens of billions a year. And the retail share class is sold at 1.45%. Some banks also charge you an upfront sales charge on top of that. But Endowus access the institutional share class, which is 0.55, so 0.9% cheaper. So 1/3 the cost of the retail fund with zero sales charges. And even if we find funds that are really, really good, and therefore we want to give access to it, and it's only a retail class is available, we would work towards getting an institutional share class available in Sing Dollar hedge share class. But if it's not available, we'll use the retail funds and we'll receive the kickback commission, and we'll negotiate as much commission as we can, but we'll 100% rebate that back to the customer. So we don't keep a single cent. So it's transparent, it's aligned. We don't get paid by anybody else other than the client. And this is the right way to do it. So the individual investor pays us a nominal fee for our services of advice, access, and cost, and then also pays the fund management fee to the fund manager, not the 1.5% retail fund, but the 0.5% institutional fund. And the combined cost of our fees and the institutional fund level fees would be below 1% compared to the 2 to 3% typically is paid in the industry. So it's a much better experience. And this is exactly what Amazon is doing in the retail space. So people talk about this Amazonification of wealth. What does that mean? It's the wholesalers who are the product guys. So in finance, we say the asset managers, the fund managers build product. They're manufacturers of financial products. And then the distributor are the wholesale guys, the distribution channel, the logistics channel. And we cut them all out. And Endowus comes in and says, we're going to be like Amazon. We're going to give product directly to the consumer without any cost embedded in between. And the clients get a much better experience at much lower cost. So that is true alignment of values and interest. What we do on top of that is provide a curation analysis so that we choose the best funds for you, so that the hard work of choosing from thousands of funds is taken out. And we negotiate for you, and we do a group buying exercise to access institution share classes or something to lower the cost at every layer, whether it's at the execution level, whether it's at the fund level, or at the custody level. And so we work with partners. We stand on the shoulders of giants. You don't have to reinvent the wheel. Many of these new robo advisors try to build a new product on ETFs, but really you don't need to do so if you can access the institutional share class. This is how GIC would invest. GIC doesn't have to build a new product themselves. They just go to the best managers around the world, allocate some capital, and then they would do the hard work of generating returns for you. So we work with every single fund manager, global and local, and we choose the best products for them, negotiate the lowest cost for you, and we offer that across the platform of all your source of funds here in Singapore, which is CPF, SRS, and cash savings as well. So all of that money can be managed on the Endowus platform seamlessly. And so this is an example I showed you earlier of the total cost. If you use the retail bank, you have an upfront sales fee, you have a retail fund class, which is much more expensive, and they often charge you a wrap fee if you have discretionary stuff. And the DIY platform is something like a fund supermart, or even a Doladex. People think it's cheaper, but they also live off of trailer fees. All of their revenues come from fund managers paying them a trailer fee. And also private banks, because it's not just the poor people, the retail masses that are getting ripped off, but actually rich people are getting ripped off just as much. So I say, it doesn't matter whether you have $10,000 at DBS or $10 million at UBS, you're still being ripped off, and you're getting poor advice, you're getting push products, you're being asked to take on leverage oftentimes at private banks, and it's a costly exercise as a whole. We simplify all of that at Endowus, and that's the institutional access. In CPF, for example, we have, unfortunately, we had no passive instruments or passive funds available prior to Endowus. We worked with Vanguard, the biggest maker of passive index funds and ETFs and mutual funds in the US, and Lion Global, a local partner, to bring passive investing into CPF. So the passive investing funds, S&P 500, Vanguard funds, and the global equity Vanguard funds are now available at CPF. So you can invest your CPF money into these passive instruments at a fraction of the cost. And we are exclusive precisely because we rebate 100% of the trailer fees that are embedded into the structure of these funds, whereas every other platform will be taking that rebate fee, and it doesn't meet the 50 basis point, 0.5% cap that the CPF board placed on passive instruments. So Endowus is the only way to access passive investing in CPF. So we're solving these problems intelligently. And we recently launched earlier this year a cash management account. So it's like a money market fund, We use cash funds, institutional deposit funds, and we also use short duration fixed income funds to blend it together into a highly liquid, relatively low risk, but also a higher yielding cash management account, which has daily liquidity. Unlike fixed deposits, it's not locked in, and therefore you can generate 1% or 2% yield including all net of all costs, 1% total or 2% returns, including this 35 basis points, 0.35% fee. We can still generate 1-2% versus, if you were going through a retail bank, all of your returns will be wiped out because the total cost of investing is above 2%. And even on fund platforms like Fund Supermart, they still charge you a fund platform fee, and they give you access to only the retail share class, and they keep the commissions, and therefore the total cost is 3 times almost the cost of Endowus. And why is this all important? Because in Singapore, this is an OCBC wellness survey from last year. 1/3 of the people don't even invest. So Aziz mentioned that some of his money is sitting, but we just hold too much cash. It's just a systematic problem that we haven't been able to take advantage of financial markets and investing. But the other third do the wrong thing with the money because they speculate excessively for quick gain or short-term gains and end up losing money, and then they get put off by investing. Or they give them poor advice and they don't get the right outcomes. Like insurance-linked product is the perfect example of that third bucket, where they think, people think they invested, so we should get, at least market returns, right? But the insurance-linked products obviously have really high upfront fees, which you have to overcome before any returns are generated. And they take off all the other stuff every year in terms of administrative costs and the premiums for the insurance piece. And you end up with a return that's, really anemic. And so they're not meeting the targets that they had originally set or they had expected. And that's a major problem for Singaporeans in general. And it's not just a Singaporean problem. Individuals have a really poor, track record. So this is the US, 20 years annualized returns. This is JP Morgan assessing their investors and saying, look, how much did they actually generate over these 20 years? And they generated 1.9%. If they had stuck that money in S&P 500, then they would have generated 6-7%. Inflation was above the 1.9% they generated. And normally it's because people have bad behaviors. So they chase markets on the way up, they sell the market, panic and sell at the bottom, like in March this year, and they don't invest enough. They hold too much cash, which are low yielding or zero yielding or negative yielding these days, asset class. So they don't asset allocate properly. They don't stay in the markets for the long term. And as a result, they get poor outcomes. And in Singapore, the biggest, problem that we face now is retirement adequacy. So 80%, almost 75 to 80% are not on track with their retirement plans, or they're behind in accumulating enough to sustain or maintain their lifestyle post-retirement. And CPF is an amazingly great total social security system. But as you know, it was built initially to allow home ownership to expand. So this whole OA piece has been used for home ownership. And the SA piece builds up, but we also use it for medical and education and other things. And so the retirement, which is CPF Life or other forms of it in the past, you get $1,500 or $2,000. It just isn't enough for most people. And so you need to do more with your cash investments to saving it up separately. But you also need to do more with your OA, because that's a piece of money that is going to be sticky, it's regularly piling up, and you're investing it for the long term. You can't touch it, it's locked up. And so that's the perfect pool of money to invest for the long term. And life just gets more expensive. Kopi prices to everything has just gone up. So there's two ways to look at your money and how to build wealth. One is your work income. So you work, you get an income, and you save a piece of it. Not that much when you're young, but hopefully as you grow older, you can save a bigger and bigger portion of your income. And you save that and invest it well, then your wealth starts accumulating. And the wealth is the piece that's supposed to take over when your work income ends. And hopefully before that. So in this chart, if you invested in a broad market exposure, then by the time you reach your late 40s and 50s, your income, work income, is overtaken by your wealth income, because your money and the eggs, from your chicken are going to be laying more than what you earn from your work chicken. And if we have like $1 million saved up, because that's kind of the rough number that people try to save up for their retirement, and it's a random number for different people. $1 million means different things, but if you start withdrawing every year, which is only 4,167 if it's 5% withdrawal rate, and this is a 4% withdrawal rate, which is $3,000 a month. If you do $4,000 a month, 5% withdrawal rate, you run out of money if you don't have any investments or do anything with it in 17 years. So if you're 65, by the time you're 82, you run out of money. And if you live to 90, then God forbid that happens. If you put it in your OA, you get 2.5%. But if you invest in even a safe investment of a 60-40 bond ratio, it lasts on average 28%. And this is kind of the spread. Long term, obviously, you take more risk short term with higher equity exposure, but long term, equity should do better for you as long as you invest over a 10, 15, 20-year period. And the more you do nothing with it, the sooner that money is going to run out for you. And these are the various simulations we've done in terms of market returns at a 4% withdrawal rate. And typically, it would still do decently well for you at a 4% clip if you invested in the markets. So if you require a $72,000 spending per year and you are trying to withdraw 4% a year, because 3,000, 4,000 may not be enough for you, and you need actually $6,000, then your money that you need at the start of that retirement period is 1.8 million. So you can do a simple calculation, using different rates of decumulation and how much money you require in retirement to sustain your lifestyle and your livelihood. And then you can work it backwards to a number that is a rough estimation, and people use this a lot. But obviously, this doesn't take into account several things. One is inflation. Obviously, this will eat away at your spending power, purchasing power. But the other thing is market returns. What if you invest this money, 1.8 million, and you can generate a decent return? Then obviously, you can actually take more money out of this pool of money, and yet you can still maintain a pool of money that will last much longer. And CPF is such an important piece to all of this because we contribute so much, right? And most people, if you start saving, through CPF, gradually will build up to a total CPF pool of maybe, hundreds of thousands, over 1 million in the case of Lou already at the age of 48. And many of you will have a certain portion sitting in your OA, even after maxing out your SA and maxing out your retirement, full retirement or retirement, enhanced retirement or full retirement sum. So the OA piece, I think, should really be, allocated more efficiently. Why do we neglect the CPF money? Because we've just been conditioned to do so. It's just money we never had. We can't touch it. It's locked up, and the government keeps taking money out of our salary, and so we just don't think about it. We don't think that there's a lot of choice, but it's also because we don't know. So there's a lack of knowledge and choice, but also we use CPF for housing, which is what we've been conditioned to do so as well. But we have to understand that CPF, we obviously have the HDB option, but if you're using it for like mortgage payment, I think it makes sense to save up for a down payment. But for mortgage payments, I think it's much better to use your cash. Because there is a gap, because effectively you're paying the 2.5%. When you sell the house, you have to put back 2.5 plus 0.1, which is 2.6% back into your OA. And so, you can play the arbitrage by actually paying your mortgage through your cash at much lower interest rates these days, probably, sub 2%, obviously, versus the 2.6 you would have to pay with your CPF. So it makes sense to actually do that. And the second thing is that, is housing and real estate the right place to be parking so much of our money when it's, there's a cost of maintenance, especially if you have a second or third home for investments. And, the returns on property, although right now we're going through another mini bubble because of liquidity, long term, I think we're beyond the time that, your HDB, you buy at 100,000 and you get to 700,000 and you make 7x on it. I think, even private condos have limited upside, especially with the prices where they are. So in terms of returns, equities has always beaten real estate over the really long term. And so, I think it's having a properly balanced asset allocation across housing, equities, and fixed income is really important. So it's a great opportunity, I think, to rebalance your portfolio, your asset allocation across all your source of funds, but including CPF. And people come back with this line, but I get 2.5%. It's great. It's much better than any FD out there. But I think it's the wrong benchmark. Fixed deposits are not going to grow your wealth. Fixed deposits or cash deposits are really something that you use to manage your short-term liquidity. So if you have cash needs in the future or you need cash in the short term, then you manage it. But if you want to invest for the long term, and CPF is, for the long term, it's locked in. Even at 40 years, it's locked in for another 25, 45. You reach 65, which is your retirement. But even beyond 65, you can keep, and beyond 55, when you can start pulling your money out, your OA account is like your long-term fixed deposit. It guarantees you the 2.5. Unless you need the money, you should keep it in CPF, take the 2.5, and maybe even invest it to get higher returns. And you can keep it there and take it out at any time. Obviously, you can't put more money in or put it back in after taking it out, but you can keep it as a safeguard and invest that for the long term. And that 2.5%, we don't know how long it will last. In the past, it wasn't a fixed rate. And with interest rates where they are and the government subsidizing this, there will come a breaking point where CPF OA may not be able to sustain that 2.5%. But obviously, I'm not going to try to predict this. We'll see. But it just isn't enough. And CPF is long-term money where you should be accepting volatility in the short term in order to generate the long-term returns that these the markets provide. And even if you invested in a relatively safe bond market, you have a high probability of success. So this is versus the 2.5%, over different periods, what is the percentage success rate of beating that 2.5%? And this was only up to September 2019. Obviously, the numbers will be even more in favor. So you should be investing your OA, and you should use your SA as your 4% kind of fixed interest kind of allocation, like your bond allocation, guaranteed 4% risk-free return. And you should use your OA as the portion that is your equity long-term investment. So using your OA and SA effectively is a wonderful way to look at how to manage CPF. And as I shared, Lou on the left and another friend on the right, talks about 1,065,000. And obviously that gap compounds over time to a much bigger difference. And the reason why CPF investing was such a pain was because, well, first of all, you have to go visit a physical bank branch and open up an investment account and go through the hassle, which Endowus has now brought completely online. So we've solved the problem of investing your CPF from an experience perspective. But also from a cost perspective, previously fees were really high because of the exact same problems I mentioned earlier about retail funds, layered fees and trailer fees built into the fund level fees, which are too high. And when we went to CPF board and said we can achieve below 1% all-in cost, they didn't think it was possible. But we were able to manage to do that with the help of UOB Kay Hian, who is our partner broker. And also we included into the CPF system as an investment administrator, the first one in 15 years, to achieve this low level of cost. And so now we are at a point where we're able to achieve really low cost to enhance the possibility of success for our investors. And so this is the globally diversified low-cost CPF portfolio that we've been able to build with some of our fund partners. And the performance has been exceptional over especially the last year or two. But long-term, it's been really good. And we've integrated fully MyInfo and the bank onboarding, even the CPF SAQ, so that all of it can be done online in less than 10 minutes without having to visit a physical branch. And we've built advisory tools around it so that you can build portfolios, have a lot of information and guidance. and full transparency of the very different fees, the rebates and the Endowus fees that we charge you, so that the total cost, versus the industry average of about 2.5%, we can generate a fee of below hopefully 1%. Or if you're only accessing more expensive fees, then maybe it could be above 1%, but largely the lowest in the industry, with no sales charges and trailer fees, etc. So Endowus is the only digital platform wealth partner that can manage all your source of funds here in Singapore efficiently, and really working towards everybody's different circumstances, their different needs and goals, and using the different pockets of money to build portfolios that are efficient and investing it efficiently. And money is meant to enable your life, not to control it, right? And in order to do that well, we need to focus on what we can control as an investor. So things that you can control are your career. If you're younger, then obviously you can control your career, build your human capital, educate yourself, like do well in your career and build wealth. But the other thing as an investor you can do is, really hone in on the investment successes of professionals in the past, and really leverage the research and investment expertise that are very common, and theories that actually work. So diversification works. Asset allocation drives 90% of returns, so you should do proper asset allocation. And the one thing that people forget is cost. Cost is just the other side of the coin of returns. So if you have higher cost, then it's going to eat into your returns. If you have lower cost, then it's going to improve your returns. And in a place like Singapore, where people don't realize you can negotiate or access lower cost options, we should try to find that low cost option wherever possible, or work with partners like Endowus, where we do the hard work for you to lower the cost at every layer. And then the final thing you can control is your behavior. So you need to know that long-term, investing in markets and staying invested works. Bull markets tend to be longer than you think. Bear markets tend to be shorter than you think. We cannot predict the future or time the markets. And so the things that we cannot control are things like the US election, the economy, the stock market returns, and short-term movements of even individual stocks. So try to focus on the things you can control, believe in the theories that have proven themselves over history in investing and investing well, and then forget about the things that you cannot control. So Endowus helps you to keep control by giving you independent advice that's value added and is suitable and is aligned to your best interest and is suitable for your needs and goals. We lower costs at every layer and make investment efficient. So this is another piece that I think many people miss, is that we need to take care of these small things like FX cost. So investing in US ETFs is costly because there's a lot of FX cost that eats away in returns. There's also tax issues like withholding tax or estate tax risk. We need to optimize the portfolio well or rebalance it to make it, a seamless experience. So we build in auto rebalancing and portfolio optimization so that we make investing easier for you. And we really approach it from a liabilities-driven model. So liabilities means in the future, what do we need this money for? So the biggest one I mentioned is retirement. So there is a cash flow that we need when we have retirement needs. Or if you have kids that are going to college, then we need to prepare for college, education, rent, healthcare, loan repayments for your mortgage. There is a cash flow need that we have in the future, which is going to be every month, or every 2 months, or every quarter, or every semester for education. And then in the future, we may have a lump sum need, like a down payment for a house, asset purchases. You want to buy a yacht or a plane, but also maybe for a wedding or a gift. And then there's continuous ongoing needs for rainy day funds or wealth accumulation. And we put that together, and life is really messy. And managing this is really difficult. And for different things, we need different portfolios. And that's why on the Endowus platform, you can bucket your money into different needs with different portfolios, with different asset allocations, and do it all seamlessly on one platform, and manage your CPF piece of it, manage your SRS piece of it, and your cash piece of it, so that you are really tailoring the needs and buckets of your money for the future needs and liabilities that you have. So this is a cash product that we have. that I explained earlier. But in the world of Endowus, your goals are precisely defined. You have a process for achieving your goals, and you have access to the experts and strategies and products to achieve those goals. And the final piece is, I mentioned that we partner with UOB Kay Hian. There's a specific reason why we do that, because we're a relatively young fund advisor. Sorry, we're a financial advisor. We're a relatively young company, and while we are well capitalized and we plan to be here forever, we're still building trust with the market and our investors. And so we try to look at how can we make this safer and build trust with our clients. And we're approved by CPF, and so we're licensed by MAS, and so all those things give comfort. But when it comes to client money, we think we need to do more. And unlike these robo-advisors, other guys who commingle the funds of different investors, we never touch the client's money. So we actually have UOB Kay Hian, which is the largest broker in Singapore, be the execution broker for us and also the custodian. So when you open an account with Endowus, you open an account also with UOB Kay Hian in your own name as a trust brokerage account, segregated account in your own name. So you transfer your funds from your bank in your own name to the UOB Kay Hian trust brokerage account in your own name. And then later on, if you take money out, you take it out from there only to the registered bank account in your own name. No one else touches it. No one else has access to it. You cannot send money anywhere else other than that specific account in your own name. So no one else can actually access it. It's the safest way to do it. It's a double ledger system. So we keep a digital ledger. UOB Kay Hian actually has the trust brokerage account ledger, and we hold it together. So even though you as a client interact with Endowus holistically, UOB Kay Hian is always there managing your money so that it's safe and kept separated from either Endowus or anybody else. So we have different fee structures with CPF SRS at 0.4%, cash, which is obviously starting at a higher level, but the more you invest with us is less. And the cash smart solution, obviously we want to give you as much yield as possible. So a flat, very minimal fee of 5 beeps. So with that, I think I'll just stop there. I think I'll stop sharing and maybe open it up to the audience so that you can ask some questions. And if you're shy, please just chat in the chat room, and I'll try to look at it and answer questions there as well. So this is the voucher again, for those of you who joined late. Special voucher for the Singapore Press Club members.
Sam, sorry.
Go ahead.
Sorry, Patrick. Something I see in here in your slides, which I'm very happy to see, is actually the time management. When you talk about the short term, 5 year, 10 year, 10 plus year, I guess that's very often something we often think about. Yes, I think very often we just think about something where you manage your short term cash flow and then you leave it to the fund advisor or financial advisor to kind of manage the whole asset allocation for the rest of it. But I'm glad to see that this one you've broken it down to time frames, and I think that so if you have almost like 4 sub portfolios, then that would actually be a very helpful model rather than just seeing it all in essentially one time frame.
That's right. Yeah. So it's our platform is very flexible, and you can use it for any need that you have. And so you can build it into different portfolios with different buckets, so that actually maybe it would be useful for people just to see a demo of the platform so that you can actually see what it looks like. Maybe that would be helpful. So I'll just log in and show you a demo of Sinting, our Chief Client Officer, and her demo account. And basically you can hold these different, so there's a general wealth accumulation goal, there's a CPF goal, which is 60-40, and each of them will have different needs. She has a 100% bond portfolio, and then a fund smart, and the cash smart, which is the short-term goal. So you can use it to differentiate your portfolios and see what it looks like. It gives you all the details, historical performance on your portfolio, and you can choose different goals, or you can do it by account, CPF or otherwise. And your historical track record will give you all the different, because there's cash flow in and out, it's difficult to calculate returns. So we provide all the different ways you calculate returns, but also, your performance in, dollars, so that you know exactly how much it changes and how much is from your investment and how much is market returns. And also, exactly how much you pay, Endowus in terms of fees. So over the 1 year, you paid 140, you received $80 of trailer fee rebates. So effectively net, you're only paying $60 to us, which is, hopefully very cheap compared to what you're able to get from elsewhere. So it's a seamless platform, and we have a mobile app, wonderful mobile app. And then, you can see on the portfolio exactly what you own, and say Apple, and you can switch this and say, oh, I have $1,000 in Apple over the whole portfolio. But what about my CPF? For my CPF, I own $416 of Apple, so you can really play around and say my whole CPF portfolio, my cash portfolio. You can create different goals and say, I want a cash smart goal or a general wealth communication goal or fund smart goal. And Fund Smart is a new product that we launched where you can actually go in and build your customized portfolios depending on your risk tolerance, and select any kind of funds. And we select the best in class funds for you, like for example, the First State Dividend Advantage, and say, I want a 60% allocation, and another one of, a fixed income bond, maybe the PIMCO income fund, which is here. And then I'll put 40%. So I build a 60-40 allocation fund and invest $10,000. And if I confirm, immediately this engine runs and tells you the two portfolios are a bit too aggressive for you because you put in a risk of -7%. But also it gives you at the portfolio level, the two funds, what the returns are, what the fees are, what the projected outcomes are, what the portfolio looks like, the fees, the complete breakdown, and the long-term historical performance of this portfolio. So you can play around with it and build a portfolio that is suitable for you. But if this is all too complicated, then you can just, build a portfolio that is suitable for you off of our existing portfolio and say, I want to grow my capital and, I have this, risk level, and we can build a portfolio for you off the rack without you having to do anything, which puts into a 40-60 portfolio of globally diversified funds that we've pre-selected. And all you need to do is just say yes by confirming and you're good to go. So it's a wonderful platform that's very flexible for all your needs for cash, CPF and SRS, and short-term liquidity, long-term investments, and satellite positions for single funds if you so choose. Any other questions that people may have? And Adam and Julie, thank you for your message. And Janet will, I'll share the presentation with Janet, and whoever wants it or requires it can use the deck to delve into it and reach out to us if you want. Yeah, and Kevin also asked for it. Yeah, hi Eugene.
That you say that UOB Kay Hian is your custodian bank or broker, right?
Yes, that's right.
Broker. Are they the only institution that you partner with, or can I have a choice that I have another custodian bank that I would like to work with you?
So we have a pre-negotiated fee. So UOB Kay Hian does not charge us anything. So once you're invested, we pay them out of our fees that you pay us. And whether you invest, you go in and out, transactions, brokerage, redemptions, anything, there's no upfront sales charge, there's no additional cost. So we've built it so that you don't have to worry about the fees or any kind of additional fees that may come in later. So we built it so that you have just a flat fee and it's transparent, it's all in and nothing else on top of it. In order for us to do that, we have to partner up with a partner who would be willing to do that. And UOB Kay Hian was the only ones to do it. We tried to, we approached Changchun at, iFast, Fund Supermart. We talked to Philip and other guys, and they wanted to keep the trailer fees. That was the first problem. So, the trailer fees, we wanted to rebate to the customers, but they wanted to keep it. So obviously it's just not as non-starter, but the total fees that they were willing to charge us as a B2B solution provider was too high. So in fact, you don't actually need to worry about KHN because effectively you working with Endowus, and Endowus is just outsourcing the execution, agency brokerage, settlement and custody to UOB KHN. Just like, we can use FundSuperMart at any broker affiliate, but it just is the lowest cost solution provider as a B2B solution. And there's no additional cost to you. But if once we work with somebody else, they need to be just as competitive or lower cost for us to work with them. So we've looked at Saxo, for example, which are too high cost. But the only other one that is viable is Interactive Brokers, who have now set up shop here in Singapore and committed for the long term. So we're engaging with them, and our platform is multi-broker platform, so we can actually onboard any other broker, but we just haven't found anybody that's willing to provide us the services at the low cost that UOB KHN does. And especially for CPF, where they're an investment administrator, they are so much cheaper than iFast and Philippine Navigator, the 3 other investment administrators. So from that perspective, KHN is the best partner for us, and it's the lowest cost partner for us to provide this service to our clients. But if there is a lower cost provider, then we will look at them. We just haven't been able to find one yet.
Sam, it's me, Patrick.
Yeah. Hi, Pat.
One of the issues is, is there a minimum investment size that you have? Because like, for example, I'm trying to get my kids to, who started work, to start investing their money, and they all say, no, Dad, I got not enough money, but there is CPF, there's they're building it up.
Yes.
What's your take on that? Do you allow
so
young people to start small?
So we do have a minimum. We set it up at $10,000. And to young people, it may seem like a lot of money, but for most people here in Singapore, and we're saying $10,000 on our platform. So it could include CPF, SRS, and cash. So your cash savings or CPF is the biggest pot normally. And across all of it, it can be 10,000. So 5,000 from CPF and 5,000 from cash or something like that. For most people who have started working for at least a few years, I think it's possible to reach. But to some people it may be high. So we allow people to join our platform with the commitment to get to 10,000 or more. And the reason is, it's not just a purely business decision that we need to be a profitable business, but really it's to help our clients. We're very missional about trying to help change people's lives and prepare for retirement in the future. $10,000 in Singapore, as all of you know, is not going to last you very long here in Singapore. Yeah. So, we want people to start with 10,000, but get to hundreds of thousands and hopefully millions or millions by their retirement. Yeah. So for people with less, and young students or younger people in the finance, starting their career, we will allow, especially if it's your kids, Pat, we'll definitely allow them to come on board with less than 10,000. But we hope that they will really commit to the long term to build their wealth and, secure their financial future. Yeah. Okay. That's why we have the 10,000 minimum, really, to help them.
Got it.
Yeah.
Sam, sorry, I've got a question.
Yeah, Aziz, hi.
Yeah, as stupid as it may sound, but how does one find out how much one can invest from the, the CPF, the retirement account? Is there a way to find out? How does one
the retirement account you cannot touch anymore.
Oh, I see. I thought there's always some sums available, right? If it's over and above.
So there's a retirement account, RA, and then you still have your OA. So if you still have money in your OA, that's investable.
Oh, I see. Okay.
Yeah.
Okay.
So only the OA is investable after you've passed your retirement age, or 65 or 55.
Okay.
So it depends.
But I read somewhere. Sorry. Yeah, but I read somewhere that it seems that you can take out your retirement account monies if you have either what is called an annuity plan or pension plan. What is that, by the way? What is that?
That one I'm not absolutely sure. Maybe I can come back to you on that one.
No, it's okay. Maybe then what I'll do is just check with the CPA, because there must be some ways of taking out. Because I see the money what I have in the retirement account is actually over and above what is required to be there.
Then you can
Then,
take out the.
no, then that's transferred to your OA automatically.
But they have not done so. Maybe I should go and tell them to do so.
No, so it should be, I don't, so you haven't checked your CPF balance lately.
No, I was just looking, you know that when you were talking, of course,
Yeah.
I sort of, using my phone, I was just checking, right? And when
Oh, really? Okay.
I logged in my CPF thing, and I was just, I mean, of course, looking at the slides at the same time. Then I saw that the amount that's supposed to be in my, technically at the time when I turned 55, what was due for my retirement account is X dollars, say $90,000. I got about 140,000 there now. So why are they not transferring that?
I think
I
so.
have to
if you
check this
onboard,
out.
yeah, I think you can check with it. But also when you just try onboarding the Endowus using your SingPass, I didn't show you, but you can just use your SingPass and use my info to log on to the Endowus website. And when you do that, actually we pull your information. We're one of the very few guys who can do that because we're CPF approved. And it will show your OA balance, your RA balance, your MA balance.
No, I mean, I know my OA balance right now, which is not much.
Okay.
Yeah, but the point what I'm driving is that, okay, what I can do is I can, of course, check this with the CPA board themselves.
That's right.
They're quite friendly, I mean, they're even willing to
talk
to
the phone. They're great. Yeah.
I mean,
so you can call them up and they'll tell you straight away.
So there is, in a sense, investable funds and even cash and all that. And I'm glad that you mentioned then you can start off with 10,000 or even 20, 30, whatever. It's not like one needs 100,000 or 300,000.
No. Whatever you can invest, you should try to invest.
How does one get in touch with you? I mean, is there an email sort of thing, or just if we go log into?
Yeah, so endowus.com, or if you scan that QR code, it will take you directly to the website. It will say Singapore Press Club welcome, invites you to start investing.
Okay, thanks.
And it will have information there. But endowus.com, and then below it will give you many ways. You can call us, you can email us, support@endowus.com. You can do Facebook Messenger or WhatsApp or whatever. So multiple ways to contact us on the website. But a phone call or an email to me also will try to follow. I'll connect you to the right people in the client team so that they can help you with all of this.
Yeah, that's good.
Sam, one more question, Sam, quick one.
Yeah.
Do you allow family accounts?
We allow joint accounts, but children is a little bit tougher because if you've grown children, they should have their own accounts because their CPF is separate, everything is separate. But you can have like your goals so that you can have a different goal under your children's name. That's possible. You can hold a joint account with your wife. You can have your own account, your wife's account, and a joint account as if you want to as well. Because you have CPF and also cash, which is joint, but CPF and SRS is individual accounts. So you should have a separate account on top of that. And unfortunately in Singapore, you have to be, I think, 18 or 21 to start investing on these platforms for some reason. It's really high. So there's a high threshold and an age limit in opening an account as well. So yeah, those are the options that are there.
Hi, Sam. Eugene here. I got a question.
Yeah, Eugene. Sure.
UOB can provide any kind of leverage facilities, like you borrow to leverage on your your investment.
Yeah. So I mean, if you reach out to us, we'll give you some information. They do provide some. I would say that they're not that competitive in terms of pricing of the leverage. And I think it has to be, I think it's 70% of your total assets that you invested. So we are able to provide it for certain types of clients, especially high net worth clients with the KHEN platform. But it's not as cheap as maybe some of the private banks, and how they provide leverage. And to be honest with you, I think for most investments, we do not encourage leverage. As Warren Buffett said, the 3 L's that the 3 deadly L's. One is ladies, the second is liquor, and the third is leverage. So we don't really encourage leverage, but we do see the benefit of using some leverage at certain points in the cycle, or if you want have safe fixed income yield products as well, could be possible as well. So we can, but I would say that we're not that competitive. in terms of pricing. Yeah.
Just to give me an idea, how much do they? I mean, what's the charge for borrowing, say, euro?
I think euro and yen are, I think, it's low, but I think it's not as low as the private banks. But we'll have to check with them because the pricing changes always. So we need to. I haven't seen a latest number because we don't do it often for our clients. Most of our clients just use the the core portfolios for investments without leverage. So we can look into it. US dollar, Sing dollar, euro, and Japanese yen are the four most common leverage. Yeah, so we can maybe look into the pricing and come back to you.
Okay. Okay, great.
Great. Any other questions? And Eugene, did I answer the question earlier that you asked as well? Or if you have any follow-up questions on that?
Sorry, say again.
Oh, you asked the question earlier and then Patrick came in with other questions. So I was wondering if the question was answered and you're okay with that.
Oh, yeah, yes.
Okay, cool.
I got one more question. How do you all mitigate? Because nowadays the market is very volatile, a lot of geopolitical issue, presidential issue, and so on. So how do you mitigate those funds? Of course, it's managed by the individual fund themselves. But then from Endowus platform, how do you mitigate those risks when volatility start to arise or even it leads to a black swan?
Yeah, I mean the
to handle it.
Yeah, so we try not to be active managers of risk or active managers trying to time the market, because over the long term, the markets do not, markets give you a certain level of returns if you stay invested long enough. And as human beings, we're terrible at forecasting the future. In every aspect of our life, we don't try to predict the future. But when it comes to financial markets, suddenly everybody has clairvoyance and start predicting the market, saying, oh, it's going to go up, it's going to go down, economy is going to be good or bad. But in reality, most people fail to predict it correctly. And it's actually, I showed you the chart about the individual investors, which over 20 years generated only a 2% return. And most of the numbers that I've seen, and there's several studies, all gravitate towards that 2 to 2.5% return for individual investors over the long run. And it's partly because they want to time the market or they make the wrong call, but it's also because they hold too much cash. So you've heard about guys around you who say, "Oh, I made a killing on Tesla. My money doubled." But then the question you have to ask is, how much did you invest? And they would say, okay, I invested $1,000, $10,000, but nobody invested their whole assets in Tesla and doubled their money. So if you look at as a whole asset allocation, they hold too much cash and they bought Tesla, and on average, they only return 5% on the total pool of money. So you have to look at your assets holistically. And if you do it holistically and remain fully invested in markets, 7% is good enough. 7% gives you a doubling of money in 10 years. And if you compound that, that leads to huge compounded returns over a long period of time. So I think it's really about being truly invested in core assets, over the long run to keep compounding your money. And so, trying to time your market is normally a fool's game. And the core of your assets should be in equities and fixed income long term. And then you can, if you want to play around or be a little bit higher risk or short term in and out of the markets, maybe a small portion of that total pool of 10 to 20%, you can do that. But the core asset allocation shouldn't change. It should be the risk level that you're comfortable with, so that even if, like in March earlier this year, the market falls 30%, you're not affected, that you're not going to sell it on the way down or try to time it. And if you try to do that, and in the US, Fidelity did a survey that 20-30% of people sold at the bottom of the market this year, and they weren't able to get back in, because as you rise, you feel that you've lost money and you don't go back in. So when you're timing the market, you have to get the call twice. You have to get out of the market at the top, but you also have to get back in below the level at which you got out. And most people don't achieve that success. So sometimes people get out at the right time, but don't get back in. And the markets tend to trend upwards over the long term. And as a result, you always miss out on returns. So I think that's the problem with our human behavior and our human emotions, is that it leads us to make decisions and make investments at the wrong time, and foolishly make decisions along the way. And if you add all of that up over a lifetime, it leads to that 2.5% return instead of the 7%, 8% that markets give you. So we would not time markets. We just advise you to find the right risk profile, whether it's 80% equities to 20% bonds or 60-40, and then try to stick to it over the long term. But we can also build slight satellite portfolios around that core allocation, which should not change over time. Yeah.
All right, thanks.
Wait, Sam, just want to pick up.
Hi, Sam.
Yeah. Hi, Janet.
Yeah. Hi. Sorry. Just wanted to interject because I think Bi Hua, she can't seem to communicate via her audio, so she has some
really?
question on the cryptocurrency.
Oh yeah,
Can you
sure.
address that for her? Thanks.
Okay. So there's a question. I asked the question to young people seem more inclined towards crypto. Okay. I think, as I said, I think crypto can be an allocation, but if you look at your overall portfolio, because of the volatility and the risk associated with it, it cannot be a huge part of your allocation. So the core has still got to be growth assets of equities, fixed income, which allows diversification benefits and managing risk short term and longer term to give you long-term trend returns. And then around it, you can build satellite portfolios like crypto, like active funds, or ESG funds, or other factor-driven models, or other things around it. Crypto, I think, is a very difficult product to really discuss, because sometimes it's called a cryptocurrency, but it's not a currency. It's actually an asset, because currency is a mode of transaction. There is a functional value to the currency. But crypto is really something that is not really functionally very useful at the moment. And most people trade it and invest in it to gain capital gains, or, so it should be actually an asset class. And young people, obviously like it and think that it's the future, and, there's, decentralization, and, the government's printing money, and therefore the fiat currency value is deteriorating. So all the arguments for crypto are valid, but I think it's too risky for most people to be allocating a huge sum of money. So if you want to allocate, sure, go ahead, allocate a small piece of your allocation, but I don't see that as a proven asset class that will give you long-term returns. It's too volatile, the track record is too short, its functional use is very low, it doesn't yield you anything like fixed income or real estate. So really, as an investment, you need to think about what the long-term yields are, and cryptocurrency is really difficult to ascertain. It's really a very speculative asset class right now. And if you want to speculate, great, but be prepared to lose all your money. And that's what speculative investment should be. It should be the 5-10% of your pool of assets where you can take higher risk, but also be understanding that you can actually lose all of that money and you'll be okay with it. Hopefully that answered the question. BH, can you respond in the chat room if you have a follow-up question? In the meantime, Stephen, I think you had a question.
I guess I know one of the additional modules you all launched was the Fund Smart. It seems like, from what I can see, it allows for the different assessment of timeframes, or I guess sub-portfolios or timeframes. The other aspect that you're talking about, this maybe core satellite approach, does it allow for that as well? Because since you in the demo of a Syntax account, or on the demo account, you kind of showed the different goals. So I'm assuming that means you could say, I'll take something for core approach, something for, say, a riskier satellite approach, and that you would be able to essentially show me how an individual goal is doing and how an aggregate portfolio is doing as well, right? Using the Fund Smart.
That's right. Yep. So the core satellite strategy is, as I mentioned, the core is a global, broadly diversified, passive strategy of equities, which gives you long-term returns, but could be volatile, as we saw this year. combined with fixed income, which gives you diversification and some level of security, reducing volatility so that you can remain invested in markets for the long term. Satellite strategies are things that are non-core that will add oomph to your portfolio, or you have personal value, so you want to like have ESG portfolios, or as BA mentioned, maybe a crypto allocation because you feel that maybe I want to have some exposure to that market. Long term, even crypto returns have not beaten equity returns, in different periods. Recently, in the past like few years, initially, obviously it did well. The other one that crypto is related to is gold. Gold returns over the long term hasn't beaten equities really. So, equities is actually a really good asset class to continue to hold. And every time people think it's expensive, but expensive versus what? Expensive versus crypto? No, probably not. Expensive versus, real estate. Property prices are at all-time highs as well. So, really is about diversification, balancing your portfolio, and really figuring out what is suitable for you. And the satellite portfolios will all be just, your personal preference. It'll be whether you want to try your hand at active investing, or whether you want different asset classes that you want to expose yourself to. So the platform is flexible, allows you to do all those things, and you can add goals and select funds, and we'll add new portfolios, model portfolios, but also new funds that become available, or we think, we find really good funds overseas, we can bring it to Singapore and put it on the platform. So the options will increase, hopefully, in terms of getting you really good high quality funds at the lowest cost that we want to achieve. So it's a useful tool, but it's an additional tool to the core. And the core portfolio is probably the right thing for 60, 70, 80% of the population here in Singapore who don't want to do anything complicated.
I guess the part of the question on the FundSmart was simply that I think trying to do an aggregated view as well as the satellite views is, I think I've not really seen it elsewhere. Trying to see that in most of the time, these guys give you one aggregated view, it becomes very difficult to separate out your, a particular model or strategy. So I think that's something that FundSmart allows, that makes it, as a platform, it makes it very something very special.
Yeah, so it's something that's not commonly available. Also, we think that it's a powerful platform that we can make even more powerful in the future, and hopefully, people will be able to use more of it. So it's really trying to help investors have more choice, and also at the same time, provide a much higher quality service for managing their wealth. So thanks for that, Stephen. And in the interest of time, we've run over our time that was allocated. So I think I'm going to have to end it there for everybody's sake, and a few people have already left. But thank you so much for joining today. Hope that was useful, and please reach out to us, Endowus.com. And if you didn't scan the QR code or whatever, then please quote your SPC membership and say you want to get the discount, and our customer service team will be able to apply that for you. So thank you again for joining us, and have a wonderful evening. Okay, thank you guys. Bye.